Chapter 8, Part 2, and what we're going to cover, and this is KESO's Intermediate Accounting, 16th edition, we're going to cover LIFO issues and what happens if you have an error. Well, again, under the international standard, we do not allow, they don't allow LIFO, but we like it. And what a lot of companies may do is use LIFO for tax and external reporting, but FIFO for internal reporting. If they do this, what they have to do is set up a reserve, which is a contra inventory account. So here's a nice little example for us. We have a company that uses LIFO for external purposes, FIFO for internal purposes. Now, at the beginning of the year, the LIFO reserve had a credit balance of $1.3 million, and at the end of the year, FIFO inventory balance was $2.9. But for external reporting and tax purposes, the balance was 1.5 under LIFO. So what should the balance be, and what journal do we have to do in order to get it there? So first, we take the FIFO balance, we subtract the LIFO balance, and it tells us that what the reserve account should have is a balance of 1.4. We subtract the current balance, which tells us we have to book an additional $100,000 to cost of goods sold and increase the allowance to reduce inventory to LIFO. So that's how you handle LIFO reserve. Another problem we can have is a company who's trying to improve their bottom line. What they may do is bring their inventory below minimum levels in order to get those lower costs going to cost of goods sold to improve their bottom line. This is a no-no under general accepted accounting principles. So here's an example. The end of 2016, their reorder point or minimum was 5,000 units, and they had a cost of $10, but to buy new parts, it cost $25 per part. Now, if the company goes to 3,000 units at year end, by transferring to cost of goods sold 2,000 units at $10 with the intentions of going back up to the minimum of 5,000 units in January 2017, they need to cost the December 2016 2,000 units at the replacement cost of $25. If, however, they decide to stay at the new minimum level, they can use the $10 for the 2,000 units. Now, another area that we use, another thing we do to value inventory and LIFO is instead of using units, instead we use the dollar value and we use indexing. So here is our example, and we're looking at 2013 through 2017. We have the ending inventory at the end of year prices, and there are indexes. We need both those pieces of information to solve our problem. First thing we want to do is figure out what the change is, and we do that by taking the current year dollars divided by the price index equals base year minus prior year base, and that will tell us our change or our layer. The first year, since it's a 1, there is no change, but the second year we end up with 86,000 as the base minus the 70,000 from 2013, which tells us our first layer at 1.05 is going to be 16,000. For the next year, we divide by the 1.16 and we end up with 82,000, which tells us it's gone down by $4,000. The next year, we end up with 88,000 doing our calculations minus the prior base year, and we have an increase of 6,000. And in 2017, we get 80,000 minus the prior year base, and we have a decrease of 8. So now we're going to use this to convert the year end in dollars to what it should do be done based on dollar value LIFO. Now in the first year, we don't have to do anything because that's the base year, so the inventory would remain at 70,000. For the next year, we have to use our index, and it went up by 16,000. So what that means is we're going to price one layer, or the first $70,000 at 1, but the increase of 16,000 at 1.05, giving us an ending balance at dollar value LIFO of 86,800. Now we'll do 2015. For 2015, we went down by 4,000. Now what this means is now we only have we can't use the 1.16 at all, and now we only have 12,000 left at the 1.05 index. So to determine our inventory for 2015, we're going to take 70,000 at 1, and then 12,000, which is all we have remaining, at 1.05, and it gives us an ending value using dollar value LIFO of 82,600, which you notice is different than what we're currently showing of 95,120. Now we're going to do 2016. Again, in this case, it went up by 6,000. However, we have to remember we only have 12,000 at the 1.05 index, none at the 1.16 index, so the increase of 6,000 would be at the 1.2 index. So that's gone. That is only at $12,000. That's zero. So now we can do our estimate of year-end inventory using dollar value LIFO. We're going to get 12,000 at 1.05 and 6,000 at 1.2, giving us a value of 89,800 versus currently 105,600. Now, our last year, we had a decrease of 8,000. What does that mean? Well, with the 8,000 decrease, it's going to wipe out the 6,000 at 1.2 and eliminate 2,000 at the 1.05 index level, leaving only 10,000 at 1.05. So all of these go away. So when we do our ending inventory for 2017, we're going to get 80,500 at dollar value LIFO versus the 100,000. So that's how you do dollar value LIFO. Now the last thing I want to cover is what happens if you have an error. Well, the rule is if the error is discovered and it affects prior years, you have to adjust beginning retained earnings in the year discovered. So in our example, cost of goods sold was 1.4 million and beginning retained earnings was 5.2, and Danny later discovers that ending inventory was overstated by 110,000 for 2016 and 35,000 for 2017. What would be the corrections? Well, for retained earnings, we'd have to adjust beginning retained earnings by the overstatement at 12/31/2016, giving us new beginning retained earnings of 5,090,000. Now for our cost of goods sold, what we have to do is we have to subtract out the amount that relates to the prior years, and we have to add back in the correction of the inventory because it's overstated for this year, giving us a new number of 1,325,000. Now that concludes the second part of Chapter 8.